Joining us this morning, Roger Altman's here at Post 9, Evercore Senior Chairman and Founder and former Deputy Treasury Secretary. Roger, thanks for coming in.
Thanks for having me.
Good to see you. Not sure where you want to start. If you believe...
Well, why don't we pick up on something that you just said, which is Goldman has raised its growth forecast for the year from 1, I think you said, to 1.25.
Yes.
But put that in perspective. At the beginning of the year, the widespread consensus, January 1, for U.S. growth was in the 2s. Now everybody has marked it down. World Bank just came down to 1.4. Goldman had gotten all the way down to 1. And that obviously reflects a slowdown. And a lot of that is usually traced to policy uncertainty or tariff uncertainty. And so what's really going on is the beginning of a slowdown. Now, it's not dreadful. We're not going off a cliff. But the economy is slowly shifting into a lower gear, largely on account of policy. And it's showing up a little bit in the labor market data. Fortunately, not too much yet. But monthly job numbers are coming down. If you look at them over a 2 or 3 year period, there are about twice as many jobs being created per month a year ago as there are now. So I think that's the main headline about the U.S. economy, beginning to slow. Now, equities are very high, and there's a little bit of a contradiction there. And we'll see whether or not, if we see greater evidence of slowdown, and it's really all about the consumer, whether the equity is correct or whether they don't. And obviously the inflation data is helping equities because it's very favorable and benign. But then you say to yourself, why is inflation improving to this degree? Why are oil prices where they are? Why are interest rates come down 30 to 40 basis points? And part of the answer is this
weaker
slowing
growth.
Yes.
But you could also look at it, Roger, as the administration came in and said, Secretary Bessent was very clear, we're going to see slower growth as we try to move away from a government-fueled, inflation-fueled, stimulus-fueled economy back to the private sector and also rebalance the entire trading relationship of the globe. And given some of those major risky undertakings, the economy so far is holding up well.
Yes, but, and look, I want the economy to do well and markets to do well. But when the administration first took office, at the very beginning, this idea of an interim disturbance wasn't their message.
True. When
they began to roll out the tariff policies and there was quite a blowback, then they said, look, we're going to have to go through a period of some pain or painfulness. But that's not what they wanted, and that's not what they initially sought.
The 3-3-3. You wanted 3% GDP. Right? You wanted 3% budget deficit. On the trade front, do you think this decline, this slow decline, can be managed with a series of rolling deferrals and extensions and handshakes?
Well, I think there's a growing sense that the impact of tariffs on growth will be a little more moderate than people initially feared. And part of that is the administration's own, it's on, it's off, it's paused, it's delayed. And there's a sense that maybe they won't end up as high as people thought and for as long as people thought. For example, the biggest duality or bilateral issue here is China. And what just happened over the last couple of days, as the Wall Street Journal editorial says this morning, is essentially a truce. It's a decision to pause. And I happen to think the Chinese are playing this shrewdly. And even though they don't have as good a hand in the thing from a long-term point of view as we do, because they're so much more export dependent. But we'll see. But I think people are beginning to say the impact of these tariffs, while negative, may not be as high or as big or last as long as we might have initially feared.